FHA, USDA, and conventional loans all sound great, but which one actually helps you afford more house in 2025? The answer depends on your income, your down payment, and what kind of monthly payment you're comfortable with. So let's break it down. First, there's the FHA loan. You can put as little as 3.5% down if your credit score is 580 or higher. If your score is between 500 and 579, you'll need to put 10% down. FHA loans come with monthly mortgage insurance called MIP. Mortgage insurance is a monthly fee that protects the lender in case you stop making payments. It doesn't protect you, it just lowers the lender's risk when you're putting less money down. One of the big benefits of FHA is the flexible debt-to-income ratio. In some cases, you can go as high as 57% if you have strong compensating factors like a higher credit score or a solid amount of savings. Then there's the USDA loan. This one is a true zero down payment loan, but you have to buy in a USDA eligible area, which typically means a rural or suburban location. I'll drop a link in the description to the USDA eligibility map so you can check your area. USDA loans also come with income limits, usually 115% of the median income for your area. There are two types of USDA loans, the direct loan and the guaranteed loan. The direct loan is for low or very low income buyers, and in that case, the USDA is the actual lender. The guaranteed version is more common. You work with a regular lender and the USDA backs the loan. The direct version can come with lower subsidized interest rates, sometimes as low as 1%. The guaranteed version includes a guarantee fee, which is USDA's version of mortgage insurance. And finally, there's the conventional loan. This one typically requires a down payment anywhere from 3% to 20%. To get the best terms, your credit score ideally should be 680 or higher, but every lender is different, so that's not a hard and fast rule. With conventional loans, you'll have to pay PMI, or private mortgage insurance, until you have 20% equity in the home. But if you put 20% down up front, there's no PMI at all. If you're trying to figure out which loan might be right for you, I've got free resources at workwithdanji.com. You'll find a quick start homebuyer guide, access to my full home buying course, and I can help connect you with a real estate agent in your area. I make content like this every week, so hit subscribe if you haven't already. So let's talk about which loan wins when it comes to cash up front. USDA is clearly the winner here because it's a zero down payment loan. That means you don't have to come up with a huge lump sum just to get started. With FHA, putting 3.5% down on a $300,000 home would mean a $10,500 down payment. With a conventional loan, 3% down would be about $9,000, but that could go all the way up to $60,000 if you're putting down 20%. So USDA lets you buy sooner if you don't have savings set aside specifically for a down payment. But I want to make a distinction here. Just because it's zero down doesn't mean you shouldn't have money saved. You'll still need cash for closing, moving expenses, and emergencies. I usually recommend having at least a few $1,000s set aside, even if you're using a USDA loan. That said, conventional loans offer more flexibility in terms of location and tend to come with fewer restrictions overall. Now let's break things down by the numbers and assume you're buying a $300,000 home. For the FHA loan, if you put down 3.5%, that's $10,500, like we mentioned before. Let's say your interest rate is 6.25%. That gives you a monthly principal and interest payment of around $1,780. Add in mortgage insurance, which is about $220 a month, and your total monthly payment is roughly $2,000. For the USDA loan, you'd put zero down. Let's assume a 6% interest rate. This gives you a monthly payment of about $1,800. Then you'd add in mortgage insurance at around $87 a month for a total monthly cost of approximately $1,887. With the conventional loan, let's say you put down 3% or $9,000 with a 6.75% interest rate. Your principal and interest payment would be around $1,820. Add about $100 for PMI, and your total monthly payment would be close to $1,920. Just a quick note, these estimates don't include property taxes or homeowners insurance, so the real monthly cost will be a bit higher in practice. But even without those, USDA usually comes out ahead on monthly payment if you're eligible. FHA, on the other hand, can end up being surprisingly expensive each month, mainly because of MIP. And because FHA mortgage insurance stays on for the life of the loan and is higher than USDA or conventional mortgage insurance, it cuts into your monthly budget, which can lower how much you qualify for. There's also an upfront mortgage insurance premium that gets rolled into the loan. For FHA, that's 1.75% of the purchase price. USDA has one too, but it's only 1%. For conventional loans, if you're able to put down 20%, your monthly payment would drop to around $1,556. That's because you're borrowing less money and you're not paying mortgage insurance. In a perfect world, I'd recommend everyone go conventional with 20% down, but let's be real, it's not realistic for most buyers. On a $300,000 home, you need about $72,000 for your down payment and then for closing costs. Now let's talk about debt to income ratio, or DTI. This is one of the main things lenders use to figure out how much house you can afford. It's your total monthly debt payments, including your future mortgage, divided by your gross monthly income. Lower is better, but each loan type has different rules. With FHA, you can go up to 57% DTI in some cases. That means FHA lets you stretch your buying power more than other options. With USDA, the DTI is usually capped at 41%, and in some cases 44% for the guaranteed loan. Conventional loans typically fall around 45%, but that can vary depending on the lender and your credit profile. So if you're looking to qualify for more house, FHA gives you the most room. USDA gives you the least. But just because a lender lets you borrow more doesn't mean you should. Be realistic about what you can afford each month. So which loan actually gets you more house? If you're short on savings and you qualify, USDA probably gets you the most in terms of immediate buying power. If you have a lower credit score and a higher DTI, FHA can help you qualify for more, but it will cost you more each month. If you've got a strong credit score and some money saved up, conventional often gives you the best long-term value, fewer restrictions, and better terms. And just to clarify, more house can mean different things. It could mean a bigger pre-approval amount, better location, or a lower monthly payment. The best loan for you isn't just the one that gets you the biggest number. It's the one that fits your goals, your credit, and your actual budget. If your main goal is to get approved for the biggest amount today, FHA might get you there. But if your goal is to pay less over time, conventional often gets you more house in the long run. So what should you do next? Ask yourself a few questions. Do you have money saved for a down payment? What's your credit score? Where do you want to live? And what's more important to you, having a lower monthly payment or more flexibility on things like location or property type? If you have no money for a down payment and you're eligible, USDA might be your best bet. If you have a 580 credit score and limited savings, FHA may be the way to go. And if your credit is 700 or higher and you've got a decent amount saved, a conventional loan gives you the most options and the most control. I always encourage people to run the numbers with a lender. Talk to at least 3 different lenders because terms and interest rates can vary a lot. The best loan isn't just the one with the lowest rate, it's the one that fits your situation best. If you want to dive even deeper, check out my video about how to choose the right loan type. It'll walk you through the pros and cons of each loan option and help you figure out what's best for your goals. And if you got any value from this video, go ahead and like, comment, and subscribe.